Ladies and gentlemen, good day and welcome to the Borosil Limited Q4 FY22 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star and then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Praveen Sahai. Thank you, and over to you, sir.
Thank you, Mike. Very good morning to everyone. Thank you for joining to the earnings call of Borosil Limited. On behalf of Edelweiss Wealth, I would like to welcome management team of Borosil Limited to discuss Q4 and the year-ending result and the outlook going ahead. We have with us Mr. Srivar Kheruka, Managing Director and CEO, Mr. Rajesh Chaudhary, Whole-time Director, Mr. Anand Sultania, CFO, and Mr. Swadhin Padia, General Manager, Finance. I would now request Mr. Kheruka for his opening remark, post which we can open the floor for Q&A. Over to you, sir.
So, thank you, Praveen and Edelweiss for hosting this call. Good morning, everyone. It's a pleasure for the Borosil team to be interacting with all of you again. Borosil Limited's board approved the company's financial results for the quarter and year ended 31st March 2022 on May 9th. Our results and an updated presentation have been sent to the stock exchanges and have also been uploaded on the company's website. As you know, FY22 was a year with its own set of challenges. In Q1, we were hit by a severe second wave of COVID, which necessitated partial lockdowns in parts of the country. It unfortunately had a high cost in terms of human lives also. Later in Q3 and Q4, India experienced a third wave by way of the Omicron variant. By then, a large part of the adult population of the country was fully vaccinated, and hence the impact on human life was less severe, though sadly not eliminated. International supply chains were also disrupted, causing delays in deliveries of materials and a surge in shipping costs. During Q4, Russia invaded Ukraine, precipitating international crisis. Even though there may not be an immediate direct impact in India, the crisis has triggered inflation in oil and gas, raw materials, and other commodity prices. Similarly, there's food inflation, which could have an impact on demand for consumer goods. In these opening remarks, I will refer primarily to the performance during the year. The details of the performance for the quarter are already available in our financial results and investor presentation that's uploaded on the website. With that context, Borosil's performance during FY22 has been a very satisfying one indeed. At a consolidated level, consumer products and scientific products put together, the company achieved revenue of approximately 840 crores, a growth of 43.6% over FY21. During the previous year, we did have a much harder lockdown during Q1 FY21, with a gradual opening up from Q2 onwards, so the numbers may not strictly be comparable. Nevertheless, FY22 had its own other set of challenges, as I mentioned earlier. Growth during FY22 has also got contributed by all our lines of business, which I will come to. For the quarter ended March 22, the company recorded a net sales of INR 220.1 crores, that is a growth of 19.6% over the same quarter in the last year. Borosil's consumer business, comprising glassware products, non-glassware products under the brand Borosil, and its opalware range under the brand Lara, crossed the INR 500 crore milestone during the year. Net sales during FY22 were INR 573 crores, registering a growth of 49% over the previous year. The sales in FY22 were even higher than in FY20 by 32%, which shows a CAGR of 15% over the 2 years which were COVID impacted. For the quarter ended March 22, consumer products achieved net sales of INR 137.5 crores, a growth of 16.5% over the same period last year. We have seen a good bounce back in sale across all our key product lines across glassware, non-glassware, as well as opalware. Our long-term strategy of expanding the field of play by participating in the entire process of storage, preparation, cooking, heating, and serving of the Indian kitchen and table are playing out well. The focus is on products of daily use. Sales of glassware products under Borosil during FY22 were 146 crores, a growth of about 42% over FY21. Each of the 3 subcategories of glass
The operator here, we have the line for Mr. Srivar disconnected. Participant, please stay connected. We'll have the management reconnected. We have Mr. Shrivar reconnected back again.
Yeah, sorry, I think I dropped out somewhere. So I just started from the sale of glassware products. The sale of glassware products under Borosil during FY22 were INR 146 crores, a growth of about 42% over FY21. Each of the three subcategories, that is storage, microwavable, and vision glasses, recorded very healthy growth of over 35%. That is to say, it was secular growth. Borosil's non-glassware products, comprising primarily domestic kitchen appliances, Hydra range, and steel surface products, crossed the INR 200 crore milestone, recording sales of INR 207.4 crores during FY22. That is a growth of 47% over the previous year. Here too, the brand achieved broad-based sales growth across the three categories of domestic appliances, Hydra, and steel surface of over 35% each. Non-glassware products comprises 58% of our Borosil branded consumer product sales, that is excluding opalware sales. The bounce back in demand of Borosil's products reinforces the equity that the brand enjoys with consumers. We are also glad about how the brand has been able to stretch beyond glassware to encompass a wider range of everyday use kitchenware products, serving products, and products for carrying food and drink. Borosil's opalware brand, Lara, also crossed the milestone of INR 200 crores by recording net sales of approximately 220 crores during FY22. The brand grew by 55.7% over FY21. Lara has established itself as a strong player in the opalware segment and is playing a key role in expanding the market for the category. Opal is growing as a category of choice for daily use servingware. The Lara business has grown 4.5 times since we acquired it 6 years ago, and I would say the acquisition has been a success. During FY22, the company did experience inflation in input costs. There was a surge in power and fuel, which comprised a significant component of manufacturing costs. Freight costs, price of raw materials, and packaging also saw significant increases. The company has cautiously chosen to pass on these increased costs in a phased manner, with some lags, hoping for commodity prices to settle over the next few months. At the same time, the company continues to invest in advertising and brand building for the long term. Advertising and sales promotion expenses of the consumer products division were about 6.5% of consumer product revenues. The division earned an EBITDA of INR 94.2 crores, that is before exceptional items, corresponding to an EBITDA margin of 16.4%. This compares with an EBITDA margin of 12.9% during FY21, which had suffered the crippling impact of total lockdowns during the first wave of COVID-19. Moving on to the scientific products division, net sales during FY22 are approximately INR 267 crores, a growth of 33.4% over the previous year. For the quarter ended March 22, scientific products recorded a sales of INR 82.6 crores, a growth of 25% over the same period last year. During FY22, the Concall lab glassware products crossed the 150 crore mark to register net sales of INR 156 crores, a growth of 23.4% over FY21. The company has embarked upon a strategy to add new avenues of growth to supplement its domestic lab glassware, foraying into the export markets for lab glassware, and to introduce a range of lab instrumentation in India. Both these initiatives are beginning to contribute towards building a healthier top line to the scientific business. They now contribute to over 20% of the sales of the scientific business and is without glassware. During FY22, lab instrumentation under the brand LabQuest achieved sales of INR 21.3 crores, that is a growth of 33.6%. Borosil Technologies, a 100% subsidiary of Borosil Limited, is developing a range of benchtop instruments and build a meaningful new line of business of the company by carving out share in a market dominated by imports. Most of LabQuest customers are existing customers of Borosil's lab glassware products. The company is now developing new products to focus on the sub-segments of environment, water, nutrition, and process sciences. The company has been building exports of lab glassware as an additional vector of growth. The company has now established distributorships in a number of countries in Asia, Africa, and North America. Besides, it has also developed OEM customers, which could provide a steady demand. During FY22, exports grew by 31% over FY21. Coming to the pharma packaging business of glass vials and ampoules under Glasspack, that business has achieved net sales of INR 89.5 crores. That is a stellar growth of 55% over the previous year. It caters to packaging for injectable formulations, ophthalmic and dental products, and sample carrier for analytical instruments. It provides Borosil's pharmaceutical customers a second credible alternative for their packaging needs. The production facility and output has passed stringent audits by its customers. Once on boarded, this proves to be a significant entry barrier to competition. Glasspack is exploring new opportunities in the areas of pre-filled syringes, cartridges, and siliconized vials. In addition, the company sees an opportunity to export, particularly to markets in Asia and Europe. Put together, during FY22, the Scientific Products division earned an EBITDA of INR 60.4 crores, that is a growth of 37.3% over FY21. The EBITDA margin was 22.6%, that is before exceptional items, as compared to 22% in the previous year. At a Concall level, the company recorded an EBITDA before exceptional items of INR 168.2 crores, that is a growth of 63.7% over FY21. The EBITDA margin before exceptional items as a percentage of net sales was 20%. Profit before tax and exceptional items during FY22 stood at INR 133.2 crores, a growth of 105% over the previous year. The company's financial results for FY22 includes cost towards exceptional items of INR 11.2 crores. We have provided a loss incurred on the account of fire at a warehouse in Bharuch on April 1st, 2021 for INR 6.4 crores. We believe most of this will also be settled by the insurance company upon completion of their due process. The actual loss on account of waterlogging at the warehouse in Bhiwandi is INR 0.1 crores. The company had purchased residential flats for its guest house requirement in a residential project at Mumbai. Unfortunately, the developer is under insolvency proceedings due to financial difficulties and inordinate delay, and as such, the company cannot ascertain the timelines for project completion or recovery of advances. The company has provided INR 4.1 crores on such property. The company has also another property situated in Uttarakhand, which had been originally bought for expansion purposes, and for which the company has carried out impairment testing and accordingly made a provision of INR 0.6 crores. The company recorded a profit after tax of INR 85.2 crores in FY22. As on 31st March 22, the company's net cash of about INR 235 crores. In line with our treasury policy, all incremental funds are invested in high-grade quality secured debt instruments, and this compromises about 80% of our cash surplus. The company has also been liquidating the legacy investments in real estate funds. The overall real estate fund exposure now stands at only about 10% of the total investments. This surplus cash will be utilized for the ongoing expansion projects for consumer and scientific business. The operating capital employed in the business on a consolidated basis on March 31, 2022 was INR 511 crores. It earned an operating EBIT of INR 120.7 crores, translating into an operating ROCE of 23.6% for FY22 as compared to 14% for FY21. The working capital employed for the consumer business was INR 92.7 crores, which is 59 days of sales, and operating capital employed was INR 298 crores. The operational ROCE for the consumer business was 24% for FY22 as compared to 11.7% for FY21. The working capital employed for the scientific business was INR 79.2 crores, which is 108 days of sales, and the operating capital employed was 213 crores. The operational ROCE for the scientific business was 23% for FY22 compared to 16.9% for FY21. With the company experiencing robust growth across business lines, it has decided to implement a number of projects to expand capacities. Work is well underway in some of the projects. There may be some minor delays owing to international supply chain issues that are outside our sphere of influence. The surge in steel and energy prices may also lead to some cost overruns. The expansion in Lara's capacity at its Jaipur plant from 42 tons per day to 84 tons per day is expected to commence production somewhere in the end of the second quarter FY23. The new borosilicate pressure facility of 25 tons per day in Jaipur could commence production by the early start of the financial year 23-24. The total capital outlay for these projects will be more than 250 crores. In the scientific products division, the company has plans to create additional capacity in glass tubing due to uncertainty in global supply chain as well as increased costs. In addition, it also plans to increase its capacity in pharma packaging under Glasspack to 500 million vials and 700 million ampoules per annum. The capital outlay for these projects is going to be about INR 60 crores. During the last quarter, we had informed investors that I misspoke. 60 crores is for the expansion at Glasspack and roughly 110 crores is for the glass tubing furnace. During the last quarter, we had informed investors that the company's board had approved a proposal to restructure the business of the company into two separate listed entities via a composite scheme of arrangement. This scheme envisages demerging the scientific business of Borosil Limited into Classpack Limited and Borosil Technologies Limited, which is a 100% subsidiary of Borosil Limited, under which the LabQuest range of products are developed, will also get merged with Classpack. Thus, Classpack will house the entire scientific business, including its existing pharma packaging business. It is proposed to rename this company to Borosil Scientific Limited and list it on the BSE and NSE. Upon the implementation of the scheme, Borosil Limited will house the consumer business of glassware, non-glassware, and opalware, and Borosil Scientific Limited will house the lab glassware, the instrumentation, and the pharma packaging business. The implementation of the scheme is subject to approval of various authorities, including the stock exchanges, SEBI and NCLT, as well as approval of stakeholders, including shareholders and creditors. Many of the steps involved have to move in series and can't be done parallelly, and therefore we anticipate that the entire process can be completed by Q4 FY23. However, we are cognizant of the fact that some of the timelines are outside our control, and hence this time estimate can only be indicative, and the actual time taken could be longer. As the responsible corporate citizen, the company has commenced its transformational journey to address key ESG issues to its context. During FY23, we will define quantifiable targets for ESG initiatives being taken. These will focus on carbon, water, and waste management for the greener planet, a safe workplace, and an equal opportunity employer. Our goal is to have resilient communities towards social equity and high ethical standards, and also manage our risk and IT infrastructure for robust governance. We remain optimistic about continuing to achieve the sales growth, as we have earlier indicated, healthier margins, and improving ROCE in the medium to long term. In the short run, of course, with the high capex involved, there may be some impacts on these numbers. The recent impact of COVID notwithstanding, the consumer business is supported by tailwinds, and Borosil will participate in a growing market. The scientific business is expected to see steady growth in lab glassware, with lab instrumentation and pharma packaging providing a fillip to its growth trajectory. So thank you for your patience, and now I'd like to throw the floor open to questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have the first question from the line of Mr. Chetan Ginodia from Alpha Accurate. Please go ahead.
Hello, sir, and congratulations for a good set of results. I wanted to understand on the opalware segment. So we have excellent growth this year, and we have reached the revenue of almost 220 crores now. So, what is our peak revenue potential from current capacity? What kind of capex are we looking for this category over 1 or 2 years? And more in general about, how are we trying to gain market share in the category, just on these lines?
Okay, so as far as peak revenue potential, I think we've already reached it, 220 crores, and if you look at my previous communications, this is the maximum revenue from the single furnace. Now, there may be some price inflation, which you can kind of add to that, but in principle, this is the maximum revenue that we can achieve. And as I've already announced many times in the past, we have gone for a new furnace, which is doubling the capacity. Therefore, that should theoretically double the peak revenue potential, and that's going to be commissioned in by September, maybe early October of 22. And the capex outlay for that is about 175 crores.
Okay. Okay. And how are you looking at category growth, given that, we are also adding capacity and a few of our competitors are also adding capacity from this year itself? Can we see, increased price competition in the market, or how do you see the growth for next 2 years for the category?
I don't see too much price competition. Frankly, the reason I'm saying that is there has been a substantial inflation in all costs, and this is not for us, for all the years. And again, it's not just for India, even this globally. So therefore, price competition, I don't see much. Yes, we will have to increase the demand, and I think there's a natural kind of way to do that by when we have more production capacity, we can experiment with new shapes and sizes, with new combinations. There's a large market which is untapped, moving from bone china and melamine to opal. And so far, we did not have capacity to really offer those shapes and sizes that those categories have. And with more capacity, we can start offering those. So I believe that, of course, it's hard to utilize the entire capacity in 1 year. But I could say in 2 to 3 years, we should aim at least that we should achieve a high level of capacity utilization with these new shape sizes. And one more point is we are spending a lot of money on advertising and sales promotion. So that should also contribute. And, we have been doing this for a while. So if you can see, as I mentioned, that when we acquired this business, the turnover was actually 45 crores. And in 6 years' time, we are at 220. So it's, we've done a fair job of being able to, expand our offerings and our, penetration in the market.
Okay. So just lastly, wanted to understand what is our margin specifically in opalware, including, excluding ad spend, if you can, point out anything, any direction.
So actually, at the moment, we don't share those numbers individually. And we are considering whether to do this or not, but at the moment, I would not like to share any numbers like that. We've given you Concall numbers already for consumer business, which I think maybe we're doing it, at least we're in the initial stages of doing that.
Okay. Okay. Thank you so much, sir, and all the best.
Thank you.
Thank you. We have the next question from the line of Keval Ashar from DSP Investment Managers. Please go ahead.
Hello, am I audible?
Yes, you are.
Yeah, thanks. So congratulations for a good set of numbers in FY22. Sir, my question is in line with the previous participant. So just wanted to understand the opalware industry in India. How big is the market size for domestic plus exports for us?
These numbers are shared we have a PPT which estimates the market size. Now, those numbers are for the opalware industry specifically. However, in my view, that the market is not for opalware, and that's not how we look at it at Borosil. We look at it as a dinnerware or the servingware market. Okay, that's our market opportunity, and that market opportunity could be north of 5,000 crores. Okay, so there's a lot of unorganized players as well in that segment. So opal itself may be closer to 1,000 crores, but there is a huge organized and unorganized segment in dinnerware across categories such as melamine, such as steel, such as bone china, which are all, I would say, target market or target segments for the opal business.
Got it, sir. And from the current revenues, how much percentage would be exports in opalware, or it's totally domestic market, which we are serving?
Exports, frankly, there's a large opportunity for us to export, especially with China Plus One. But quite frankly, the pricing is quite low. So we restrict our exports so that we can satisfy the needs of the domestic market. So opportunity is one thing, and what we are doing is another. So the opportunity right now of exports could be as high as 100 crores plus. But we are restricting our exports because there's a huge demand in the local market, and we have much, let's call it, we have a longer term play here in the domestic market than exporting, our brand overseas.
Got it, sir. And the last question is that just wanted to understand your vision. So over the last 5 years, you've transformed the company from a single product company to a multi-product company, from a single brand company to a multi-brand consumer and a scientific company. So what is your vision for the next 5 years, and where are we heading towards for the consumer segment?
See, I just want to change while the transformation has happened, it was not intended to transform the company from single product to multi-product. The intention was to be close to the customer. And the idea even in the next 5 years is to be close to the customer. Now, whatever the customer demands, we will do. Okay? Wherever we see business opportunity and what the customer's needs are, we will kind of do that. So I can't predict where we'll go in 5 years, except to say that we listen to our customers every day. And as we listen to our customers, we will evolve our strategy going forward. So what new product launches, what new manufacturing, all of that is really dependent on what we hear. At the moment, I can tell you our plan is to do more of what we're doing, which is growing our Opal glassware business, setting up production of our borosilicate business, and expanding the storage segment, expanding the appliances segment, the servingware, which is Opal. These are areas where we see substantial opportunities. Frankly, 570 odd crores, which is our consumer business, is still a very, very small business, consumer business firm in Indian context. So I feel there's enough room to grow here. But I'm not one to put some grandiose visions because, frankly, I don't have any.
Got it. And since you are now aggressive on the appliances side, are you planning to backward integrate into appliances, or will you do trading as of now?
No, for the moment, I think the trading model works very well. And frankly, I don't think we have the volumes to backward integrate at the moment. So unless something changes, I think it will take some time for us to settle that business. It's still a small appliances company compared to what others are doing in terms of revenue and volumes. So while we have started the journey quite well, but long way to go before we start talking about backward integrating.
Sure. Thanks a lot, and all the best for the coming years. Thanks.
Thank you. We have the next question from the line of Rajesh Kothari from Alpha Equity Advisors. Please go ahead.
Hey, hi, sir. This is Rajesh Kothari from Alpha Equity Advisors. Just, two questions from my side. On the consumer business, if I look at the fourth quarter, then the growth has been almost like flat or kind of a growth compared to last year fourth quarter. So, what is the reason for that? That is because of your capacity utilization is at peak, right?
I won't call 16% flat, frankly. I would not call 16% flat.
No, I'm talking about Opalware, sir.
Opalware. Opalware, we have no capacity there.
No capacity, correct. And, you mentioned, I think your voice was missing in between during the call. So you mentioned that for Opalware, you are putting up a capacity of 175 crores. Is that correct?
That's right.
Hello.
That's right.
Okay. And what is your strategy for non-glassware?
See, as I mentioned to the earlier individual, we are a very small player in non-glassware. We've seen a lot of traction in the market for our brand, and our quality is well appreciated. So in the long run, yes, for sure, we would need to backward integrate, but I still think that's 2-3 years away. If you had to guess, that would be 2-3 years away because we need to build much more volume there before we start talking about backward integration.
Correct. So basically, non-glassware particular segment, do you think that in this segment, because our size currently is too small, and probably it may require significant brand investment or maybe, some different strategy whereby probably you may have to compromise on the profitability because, it is still, about 200 crore kind of a revenue size. So what is the company's strategy over here? Whether, for example, whether you'll be happy even with say 5% margin, but make it, 500,000 crores because you need to make a lot of investments to make it build from here on, So on a small base, it is, probably a little bit easy journey, but as you move from 200 to 500 crores and then to 1,000 crores, the journey becomes quite difficult. And if I look at many other players, like for example, Polycab, and they moved into FMEG and many such companies, the margins initially, till you reach 1,000 crores plus, are very low single-digit kind of a margins. So I'm saying from that perspective, how one should look at this business?
Yeah, look, the focus has never been short-term margins for us, okay? In any business, the focus has been doing the right thing and growing the top line of the business, I think we are intelligent enough once we have a certain scale how to make the margins happen. So when you talk about margins, it's one way to look at it. I would look at the let's call them the non-manufactured part of our business more on a ROCE perspective rather than an absolute operating margin perspective. Because if I'm making 5% margin, every month, and if I rotate my capital 12 times, then I'm making 60% return on my capital employed. Okay. So the question is that I'm not over fixated on the margin on that business, but more on the return on capital that we employ. Obviously, the margin becomes very important when we put in a lot of capex. For example, the glassware business and the opal glass business, here we put in substantial capex. Here the operating margins have to be much higher to justify the capex that we spend. So I think on the non-manufactured part of our business, which is again the non-glassware bit, that I think our margins will be lower compared to the glassware and the opal glassware business. But if you look at it from a capital employed perspective, I would say it's not that far off. Meaning the return on capital employed perspective, it's not that far off from the other two businesses, which is okay for us. And we obviously look for areas for margin expansion going forward as we pick up scale. But it's too early to say.
So what would be the reason for if I look at your overall consumer wear business margins, they moved up from 12.5 to 16.5. So what is the key drivers for that? Number one, and number two, how one should look at the margins in this business overall over the next 2, 3, 4 years?
See, the margins, as far as we are fully utilized now in terms of our Lara. That has a major contributor to margin expansion in consumer business. The second thing is, if I talk about going forward, I think in the short run there may be a little bit of stagnancy in the margins because of the new capex that we're putting, and as it comes on stream, because it won't be fully utilized, and therefore you'll have high inventories. You'll maybe have to discount the products just a little bit, or spend more on advertising, either of the two or maybe both. So I would say in the next year or two, then, and plus of course there's huge inflation happening at the moment, so it takes time to pass it on to the customers. So in the short run, I would say in the next 12 to 18 months, there may be some pressure or stagnancy on the margins. But if we are doing our job right, then probably in 2 to 3 years, which is I guess your question, the margins should significantly expand from the 16%, hopefully to north of 20%.
Oh, is it? Okay. So you're saying basically as the utilization comes full on stream, the expansion in margins, I'm saying from say third year perspective, so what would be the key trigger for that expansion in margin? That's what I'm trying to understand. I'm saying 3-year plan. I'm not talking about
capacity utilization. Capacity utilization.
But currently also we are fully utilized, right? At fully utilized, then say for example we are reaching say about 16% margins. Let's assume there is a new capacity which also becomes fully utilized.
No, the economy of scale also comes now. Because today, when you have 570 crores, many of our costs are fixed costs. The moment we are fully utilized with a new capacity, our turnover will jump to 1,000 crores plus. So then many costs are, for example, your overhead, for example, advertising, sales, promotion, for example, manpower costs, our own ability to negotiate with suppliers. All of this will add to our margins. It should take us over that 20% hump.
Perfect, you're right. Great. Thank you, sir. I'll come back in queue.
Thank you. We have the next question from the line of Rahul from Monarch Network. Please go ahead.
Yeah, congratulations on the good set of numbers, sir. Just a couple of quick questions. Just want to understand, sir, are we facing any capacity issues for opalware? Have we lost out some sales because of capacity issues? And do you see this as a hindrance for the next couple of quarters?
Yes, both the questions are answered yes. We are losing out on sales because of capacity issues, and this will hinder us at least till October. So, unfortunately, that's a sad truth.
Okay, so and just want to check, sir, what kind of pricing action have we taken in the consumer segment? In terms of what kind of price hike?
I think in general, the price hikes have been north of 10%, and some products even as high as 15-16%. So, I'm talking about consolidated price hikes, say from February onwards.
All right. And you think that would be enough for now, or do you see commodity headwinds still continuing, sir?
Look, I'm not a soothsayer, so I don't know what will happen to commodity prices. But frankly, at the moment, whatever we've taken is good enough for the time being. But there's craziness happening in the world at the moment, so nobody knows what's going to happen tomorrow. And therefore, our teams are fully aligned. And as soon as any costs go up significantly, that there's a communication line within our team to immediately pass the information on to the product management and the sales and marketing team to take appropriate price increases. But it's an extremely dynamic situation, and it's quite taxing actually.
Sure, sir. Thank you so much, and all the best, sir. Thank you.
Thank you. We have the next question from the line of Manav Vijay from Deep Financial. Please go ahead.
Yes, thank you very much, sir. Sir, a couple of questions from my side. First of all, if I look at quarter 4 PPT, you have increased the lab instrumentation market size to 570 crores from quarter 3, where you had mentioned 200 crores. So is export the main reason why you have increased the market size, or because you are introducing new products?
It would be the latter. It would be because we're introducing new products, and also the market size, as already mentioned in the footnote, these are internal estimates, okay? So we reserve the right to be wrong. And I think we were a little bit wrong on the market size also, plus the new products. So all put together, we see the opportunities growing.
Okay. And so you have also mentioned a couple of times in the past that that you're looking to have around 10%, 8 to 10% of this market size. So now with this, let's say, correction in the market size estimate, so that 8 to 10% with a 2 to 3 year time frame still remains true?
I'm sorry, I don't remember saying 10%, but maybe I have. So, but yes, I mean, effectively, I think that's not a tough. That's not too challenging for us job to take. And if we're spending all this management time on that area, and we should at least hit a 50-60 crore number in that period. That should be the target.
Okay. My second question would be, sir, regarding the entire capex that you have lined up, or I've said that you have articulated over last 3-4 quarters of approximately now 450 crores segregating. So between now and I would say quarter 1 FY24, this entire capex gets online. So I believe that in FY22 you have spent roughly 80 to 90 crores so far, and approximately 350 crores or 360 crores still is what you will spend in FY23. So is that I would say assumption more or less correct?
Yeah, your information is correct. You've done some good math here. So your assumption and your estimations are more or less correct. The caveat I would like to say is that we would like to spend the money faster, but because of supply chain bottlenecks, we're not able to spend the money because suppliers are delaying their kind of dispatches to us. So ideally, we would absolutely like to spend this money, which you just mentioned. But my fear is that right now everything is running a bit behind schedule.
Okay. So which basically leads me to actually to the your next question is that now considering the way the prices have moved up of almost everything in last 3, 4, 5 months. So this 450 crores still true? I would say stays true. And if not, then what 10-15% kind of a price hike is possible?
Yeah, that's a good point. Now, luckily for us, we did many of the ordering of this 450. A lot of it we did prior to this 5-6 month price hike. So in some sense, we got the benefit of that. But yes, to the stuff which is not yet ordered, there will definitely be a price hike. And that price hike may be in the range of 15%, I would say. But frankly, that is a lower portion of the overall spend. So overall, Concall maybe about 7 to 10%, 5 to 7 to 9%. That range probably would be an expansion in the overall, capex. But fortunately, it'll be limited as we were able to place a lot of the orders before this.
Sure. Okay. My third question would be, sir, in your balance sheet, there are 2 things that I could not understand. One is your, actually under your current assets, there is a 61.4 crores of assets held for sale, which last year was 0. So what is this for, sir?
Yeah, look, they are mainly, look, the idea for us is to, as we're doing all this CapEx which we just spoke of, we would like to be capital efficient. So most of this, there are three assets which are now we have transferred to held for sale. One is our own office in BKC, okay, which is a chunk, and the return on capital is quite low because the rental yields, etc., are less than 10%. But our return on capital targets are much more than 10%. So that is one asset. Second is one of our plants in Tarapur, which is also something that we are considering what to do with. And the third is a plant in Chennai.
So you intend to put them on the block?
Yeah, yes, that's correct.
Okay, and this capital in turn will get deployed back in the business for a higher ROCE.
That's the goal. That's the goal.
Perfect. This is very helpful. My last question to you would be, sir, similarly, under your non-current assets, there is a 42 crore increase that we see. So are these advances paid to the suppliers or something else?
Yes, that's right. That's the advance paid to the suppliers for the capital expenditure.
Okay. Last question. Tax rate for FY23.
I think we've now opted for the new tax regime. We have the option to do that. So we've done that this year. So I think it's 20% plus surcharges, etc. Should be 25%. Please correct me if I'm wrong.
That's right. Anand. That's right.
Okay. Thank you. All the best.
Thank you. Participants who wish to ask a question may press star and 1 on their touchtone telephone. Participants who wish to ask a question may press star and 1 on their touchtone telephone. We have the next question from the line of Amrish K, who is an individual investor. Please go ahead.
Thank you for the opportunity and congratulations on another good year. Thanks also for the additional disclosure on the capital employed. I think this is quite helpful going forward. Two questions. First on the consumer business. On the non-glassware, you've talked a little bit about the business. Is it possible to consider going forward to perhaps split out the appliances from the Hydra and the steel, maybe as we get bigger, just to understand the drivers of this business a little better?
Yeah, I think that's a reasonable request, and that's something we'll consider. I'm just a little bit hesitant to do everything at once because I want to make sure I'm doing the right thing in terms of sharing data. Sure. And what is too competitive to share. So I think in the next 12 months probably we'll have to be very clear what we will share and what we won't. So hopefully that your question should be answered by then.
Okay, thank you. Second is on the lab instrumentation. I don't want to get too excited, but it's a big jump up. I know it's percentage-wise it's similar to the overall annual number, but the roughly 8 crores, is there something that's working, or is it like a one-off? Do you think we're going to see some more momentum?
No, it's not a one-off for sure. It's not a one-off for sure. We've got some good orders. There's no doubt about it. But I'm little cautious to start jumping from the balcony yet. We need to work much more, and there's a lot of opportunity. So these are things that will take time. This is not like our consumer new categories you launch within 3 months whether it's successful or not, because consumer response is very fast. In the case of lab where you're selling to R&D institutes, you're selling to pharma companies, the response is much more measured, much slower. So it just takes time, and one mistake also causes you get set back by 6 months. So this is a business where I think we just hold our breath for a little bit, and things are working well so far, and hopefully they keep working well. But if we do, I think we'll have a really sizable opportunity, margin, and return on capital. I mean, everything it ticks all the boxes, frankly, this business.
Fingers crossed. Last question, if I may.
Would you be able to rejoin the queue for the questions?
Oh, sure.
Follow-up questions.
Sure. Thank you. Thank you. All the best.
We have the next question from the line of Mr. Rajesh Kothari from Alpha Equity Advisors. Please go ahead.
providing an opportunity again. Sir, my question is, since you are going to have two, companies, both companies will be listed separately, in terms of the management structure, can you throw some light on that?
Frankly, the companies already operate as two separate entities. Okay, it's just that they're together. The entire management of the scientific division and the consumer division are entirely separated, except for me. Okay.
Okay.
So there's very few shared services which will continue as shared services even post that, and probably one company will discharge the other for some. I would call it like stuff like legal, where you don't need to have two senior legal people. You can have one, and there's not enough work, frankly, to justify having two, or corporate secretarial, some IT stuff, at the back end is in terms of SAP fairly integrated, etc. So there would be some shared functions which would continue. As far as the plants are concerned and the sales are concerned, the marketing is concerned, the new product development is concerned, all is completely separated altogether already. So I don't envisage a major change in the management structure at all.
Okay, and you'll be focusing more on, so you'll be at the whole co kind of level, and then you have two CEOs reporting to you, or you'll be part of one company,
Yeah,
somebody else will be joining.
I mean, practically I have to be in one company. I can't be in both. So practically speaking, I will have to be in one, but definitely I'll be on the board of both, and there'll be business heads which already are in place who will report into me. And same now, what exactly designation to call them, that's something that we'll have to debate. But I guess we'll do that closer to the date we are sure that this has been approved by the relevant authorities. But in principle, I don't see any major change in the management structure. I mean, in practical terms.
Okay, so basically you are saying that the two heads are already there, and so one of them might be elevated, kind of thing, something like that. That's what you are trying to suggest.
Yeah, and for investors, it's in my view, a very positive thing, because you can be you depending on your proclivity towards which side you like, or maybe both. You can either stay in both or stay in the one that you like. So yeah.
Sure. Second question is, on this.
Mr. Kothari, I request you to come back in the queue for that follow-up questions.
Okay, no worries. Thanks.
We have the next question from the line of Arun Maruti, who's an individual investor. Please go ahead.
Yeah. Am I audible, sir?
Yes, we can hear you.
Yes.
Yeah. Thanks for the opportunity, sir. Under your management, we have this firm belief that we are going to make money. And my question is with regard to the Lara, sir, that in our information memorandum published in 2020, we wrote that by doing some small investment of around 15 crore, we can enhance the capacity by 20%. So what is our view on that?
Actually, we did that already. We did that back then only. And if you see earlier, if you go back in the past, I was always maintaining that our total sales we could achieve from the current business was 180 crores. And now we are actually doing 220. So roughly we expanded our capacity already. This was back in the time. Now that there was some debottlenecking which we achieved. And now we really have to just take a step jump up.
Okay. And my next question is with regard to, sir, ECD segment, that recently we have launched that oil-based filter for the winter season. So I would like to know your views for the ECD segment, whether we are planning to move in that segment in a bigger way, or what is our view?
So quite frankly, I'm the wrong person to ask this question to, because product development and what we launched is, they're fully empowered to do what they like, and they do experiment a lot, okay? So our product management team and our marketing team, they keep experimenting with new products. Some things work and some things don't. Now, specifically, I don't have the background on this, although, of course, I know we launched these OFRs, oil-filled radiators. But what is the plan for the future, frankly, and with respect to products which are close by to that I frankly don't know. So I'll have to talk to my team and come back to you.
Okay. And sir, my last question with regard
to the operator, would request you to kindly come in the queue for the next follow-up question.
Okay, thanks.
Thank you. We have the next question from the line of Amit Agarwal from Bowman Capital. Please go ahead.
Hi, thank you for taking my question. First is on the capex that we are doing in glassware. What, in terms of margins, a benefit that we'll get from this capex?
It's hard to predict. Again, there's a play between margins and increasing the market. Okay, so the question is that initially our goal will be to increase the market size, and even if we have to maintain. So obviously, anything we manufacture should be a much higher margin than what we're currently achieving. But on the flip side, we may choose to forego the margin in the shorter run in order to achieve higher penetration of glassware in the market. And kind of get customers to switch away from plastic and steel. So these questions will be answered closer to the time we manufacture the product. But in principle, if I was to sell at the current price and with the cost of production that we anticipate, the margin will jump in double-digit percentages.
So in improvement of more than 1,000 bits.
Yes. But that's a very theoretical point I'm saying, because it depends on. Again, the question is we need to achieve full capacity utilization. We need to achieve more market penetration. So it's a theoretical calculation, but practically what will happen, we'll see. So it will be somewhere in between 0% and 10%, in my view.
Got it. And second is around the demerger. So post demerger, would there be any RPTs between scientific wear and consumer wear entities? And second is since there will be two separate entities, will there be increased cost, fixed cost, especially corporate overheads or compliance-related, overheads? If you can answer both of those questions.
Yeah, look, RPT, as I already mentioned in the previous, or maybe a couple of questions before, there will be shared services, and the idea for the shared services is exactly the second question you asked about not increasing the fixed cost. So, in order to not increase the fixed cost, we will have shared services, and those shared services will therefore have to have RPTs associated with them. But
will there
be RPTs between two listed entities, not between promoter and.
Got it. And Srivar, will there be, so for example, we have a plant in Gujarat which also makes consumer wear product, right? If my understanding is correct. So would that continue?
That will continue. Although that's a small percentage of both overall sales, but yes, that will continue.
Got it. And if I can squeeze in last question on the non-glass consumer wear. You mentioned we have taken price hike of more than 10%, and our year-on-year revenue growth has been around 16%. So if you can give some color in terms of what is the volume growth in this segment?
Price hike, by the way, was not taken on the whole quarter from January 1st. The price hike we started taking Feb 1st, practically speaking, you have inventory with old pricing, etc. Practically speaking, the price hike pays out only by March, April. Okay, so now coming to volume growth, I don't have the data. It's also a little bit complicated because there's so many thousands of SKUs. It's not like a commodity company where, or it's our other FMCG companies, they have huge sales of, some SKUs so they can easily calculate the volume growth. For us, there are many SKUs, all which sell in lower quantities, and therefore, when you do a quarter-on-quarter reporting, the volume growth becomes a bit challenging. Lara, for sure, the challenge of volume growth was there. It was flattish because of the non-availability of product itself with us, for which I already mentioned that we are sold out on capacity. But on the glassware, Borosil branded and non-glassware, we saw, I would say, more than 15% at least volume growth. That's my estimate. But again, these are very broad numbers and hard to quantify.
Okay, got it. That answer. Thank you.
Thank you. I would now like to hand the conference over to the management for closing comments.
So thank you all. It's been a challenging year. Started with challenges and ended with other kind of challenges. And I see these challenges continuing in terms of the cost pressures in this quarter, and the uncertainty globally is high. There's no doubt about that. But I would say one thing what we've achieved well as a team is that we've become a lot more resilient, and a lot of decisions are made very quickly because everyone knows that the market outside, the external environment rather, is changing also rapidly. So we have to change rapidly. So I think there's some good stuff also that's come out of this, these crises. So we are still very bullish on the business on both consumer as well as scientific, and nothing has changed from a longer term point of view. Short term, we are clear that there may be some hiccups, but I think we can go through that. So I really would like to thank all of you for participating, for your support, and as somebody said, I hope we can all make good progress and growth together. So thank you, and we'll see you next quarter.
Thank you, sir. On behalf of Edelweiss Broking Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.
Thank you.